Good afternoon, everyone, and welcome to How Wireless North American Operators Are Investing in LTE and Small Cells to Remain Relevant, highlighting the results from our recent U.S. and Canada telecom benchmark. My name is Allison Crawford, Senior Marketing Manager here at TBR, and I will be your host for today's session. Technology Business Research's focus is to provide business research to accelerate our clients' success, and this webinar is a part of these ongoing efforts to find new ways to support you and your business, helping you get the most out of your research investment. Before I pass this over to Michael, there are some logistics I'd like to cover. First, we will be recording today's session and posting it on our YouTube site, TBRI channel. We encourage you to visit our channel to watch this presentation or any of the others we've posted. Second, we'd like to hear your opinions and thoughts on the materials we're presenting. Please send any questions or comments to the Q&A function or the chat function. We'll address them at the end of the presentation, or you can request an inquiry call if you have additional questions. Third, we'll send out the slides to everyone registered for today's webcast within 24 hours of the conclusion of the webinar. You can also find these slides, as well as other thought leadership pieces, webinar decks, and commentaries on SlideShare at www.slideshare.net/TBR_market_insight, and we'll share all these social media links with you at the end of the presentation. Now, let me introduce Michael Sullivan, trainer. Michael is our resident expert in TIS, LTE, broadband, fixed access, wireless access, backhaul, OSS/BSS, smartphones, tablets, and MDM. He has keynoted presentations around the world, and his advice is highly sought after in the telecom space. His insight has helped our clients improve their strategic go-to-market plans and market position in the telecom vertical. And with that, let me hand this over to Michael.
Thank you, Allison. Thank you, everyone, for joining us today on this webinar. We will be examining service provider spending in North America on a bit broader terms than LTE and small cells, though that's certainly one of the drivers. We're going to be looking at the overall growth drivers for North American operators for their business today and for their future business model, and highlighting some of the capex, opex spending analysis that we do for North American operators. We cover 24 operators across North America on their spending and revenue growth and strategy. And we'll be focusing specifically on AT&T and Verizon towards the end of the presentation. But first, we're going to look at the fact that the market is based on capital-intensive data growth, that there's a transition in the market from operator-centric to customer-centric business models, and we'll look at some of the requirements of those business models, as well as ways in which the operators are beginning to invest in those requirements. So let's get started. First off, here are some very important numbers that we think have a strong reflection of the marketplace. One of the key things that's developed in the market, as we all know, is that the market has become covered, or is close to being 100% covered by LTE. That's what the 90% represents. 90% of the market has LTE coverage, and at the rate operators are rolling out LTE, it will be 100% covered within the next few months, with the first wave of LTE essentially being complete. As we'll comment, there's at least another wave of LTE, a densification wave of capacity coming in that's going to be a strong feature of the market in the next couple of years. Next figure, 150 petabytes, is the fruit of that LTE deployment, which is the amount of data per month that is mobile data that's passing over the mobile networks in the North American marketplace. This, of course, is being generated by the plethora of new devices that can relate to the LTE network and deliver traffic over the mobile network for a variety of mobile services. The next figure, $140, is the ARPU. The average ARPU has increased to this $140 rate for the Tier 1s. Not everyone can collect this ARPU, obviously, largely through a combination of, interestingly, not necessarily monetizing data services, but the combination of connected devices and device bundles and smart devices that operators are operating within the market to leverage the LTE network. Then we have the $16.5 to $20 billion figure here, which is capex investment. of the two largest operators in the market, AT&T and Verizon, Verizon being the $16.5 billion player and AT&T being the $20 billion player. Highly capital-intensive marketplace with this level of spend in order to generate that $140 per user and manifest the high rate of data traffic. And as we'll see in a few minutes, this may not be the best business model to continue with, but it's certainly the one that the marketplace has been dominated by for the last few years. The last figure there is a figure that many of the marketplace players are focused on. It's $50 billion, which represents something that's become very familiar to many of us covering the industry, the 50 billion connected devices that are expected to be connected with mobile connectivity in the coming years, and finding a way to monetize those devices through different business models is one of the key strategies to extend the value of this massive investment in capacity. So that is the state of the market today, high capital intensity, relatively low return on the investment on that capital. Where have we seen that before? We've seen it before in the railroad industry. Here we're showing an example of the deployment of the Golden Spike here where Union Pacific and Central Pacific railroads joined to create the first transcontinental railroad in the United States in 1869. It represented a culmination of the railroad's ability to lay track to do 100% coverage, but it also represented a turning point where, with all the track laid, what was the railroad to do next? And as we know, the railroads have significantly suffered. One of the reasons they've suffered is because the business model change that took place at the time was it moved from revenue based on laying track to revenue based on carrying cargo. And so the content of the cargo actually became more important as a monetization tool than the track itself. And we bring this analogy up to compare that to the North American marketplace today, where we see the rollout of LTE and the maximization of capacity throughout the marketplace as very similar to covering the U.S. with track. And we see the cargo that's being carried over the network, majority monetized not by the operators in the marketplace, but by other players. And this puts the operators in the marketplace in a very similar position to the railroads of the past. What became of Union Pacific? Well, we know the company still exists. It finally did get into the cargo business, but it ended up merging with its large rival Central Pacific to create a smaller company focused not on the connectivity as much as what rides over the rails. Could we be seeing a merger of AT&T and Verizon one day? Well, hopefully not, probably not, because they're making business model changes, understanding this paradigm shift. To put a finer point on it, what are the forces of change that are impacting these service providers in our marketplace? The first one, as we all know, is the commoditization of voice, which has been a leading generator for margin for many years. We continue to see voice revenue decline both on the mobile and the fixed side. In fact, a significant revenue shift that's going on is substitution of mobile connectivity data revenue with what used to be voice revenue. So it's not necessarily a high growth opportunity, but a maintaining of revenue for the operator, and leads to flat to declining margins overall, ultimately causing the operators in the market to seek new sources of revenue to find out ways they can further monetize the capacity they've delivered. The other major challenge they face is disintermediation, and this is probably the most significant challenge, being relegated to the data pipe. By that we mean those companies that are collecting the majority of revenue from mobile data services are the Googles of the world, the Netflixes, the Amazons, the over-the-top players, the plethora of internet companies who today collect subscription revenue and have put together, as the internet model has moved to the mobile device model, supported by the upgrade in data capacity provided by the operators, the revenue hasn't necessarily moved for the operators, hasn't really moved at all to the operators. It's stayed with the internet and over-the-top players. causing the issue of the data pipe potential for the operators, where they suffer a diminished brand and have a decreasing over time profitability per bit, much as becoming a utility. The third issue they face, of course, in this marketplace is saturation. As we just highlighted, we're nearing 100%, or nearly 300 folks in the United States, for example, having access to LTE network from not one but multiple operators. So the only place that subscriber growth will come is by taking the subscriber from a fellow operator, creating competition on pricing, and bringing about the stage of consolidation and acquisition we're beginning to see in the marketplace. The move that AT&T is making on Leap Wireless, the move they tried to make on T-Mobile, T-Mobile's move to capture Metro PCS, and of course Softbank coming into the market, consolidating Sprint and Clearwire. These end up being a marketplace of a handful of very large players who are able to compete at the scale required to roll out the capacity and get enough volume to justify the price points that the market will bear, particularly as we have the coming further postpaid and prepaid battles on price. Last but not least, operators are in this marketplace, as we all know, are conglomerates really of a collection of operators, the RBOCs forming together to become an AT&T or a Verizon or a Sprint. And over time, this places in the market a lot of legacy network. And so there's a degeneration of the legacy infrastructure that requires a constant expense on OPEX and in some cases CAPEX as well to drive continued usage of the legacy infrastructure. And we have dates like 2021 for when, for instance, Verizon will retire its 2G and 3G infrastructure, essentially its CDMA infrastructure, which ran the marketplace for so many years. That's a long time to carry that kind of expense on the books and maintain an end-of-life position with that technology. So that drags on revenue and margin as well. What's the answer to this dilemma faced by the operators then? If spending billions of dollars on LTE and monetizing the data at the subscription level that they've done isn't enough, what can they do? We perceive that they are in the throes of moving from a service provider ownership and control model, essentially a connectivity-based vertically integrated model, to a horizontally integrated customer experience enabler model. And the chief difference here is the operator believed in the network provider model that they had end-to-end control. They would roll out the capacity, and in addition to controlling the access revenue, they could also control content revenue. Many attempts through the years in this marketplace of trying to create content, deliver content, get the users to pay for content at the scale and popularity of what we see the internet content players be able to do, the media companies be able to do, and the OTT players be able to do. So clearly the mission to be controlling the content layer has failed, and a lot of the enablement layer has become quite accessible and open to the internet players, the over-the-top players. So the model is breaking down for the network provider, as we've discussed. That essentially is the capacity data pipe model as we see it going forward. The alternative that is quickly emerging is the customer experience enabler model. Here the network and network capabilities, the service enablement, service exposure capabilities, and a few others we're going to mention, become the heart of a operator operating across and catering to various kinds of business models. So enabling degrees of quality of service or degrees of customer experience or customer analytics for the over-the-top player in a way that the service provider can, that few others, that the OT players cannot do themselves. Similarly, enabling rollouts of M2m in different verticals, connected car, healthcare, education, bringing the unique network connectivity requirements overlaid with other quality of service enablements and also analytics, bringing in this set of capabilities that the operator can contribute to an ecosystem, enable an ecosystem in these different business models. This is where we believe the operators are moving, and there's many examples, some of which we'll highlight here, where they're beginning to experiment with these business models. Needless to say, none of them are generating the kind of spend or revenue that we expect that they will generate in the future as spend transfers from the network provider model to the customer experience enablement model. To put a finer point on this section, what are some of the key attributes that will be important in the customer experience enablement model? Well, one of them will be an increasingly agile network. This presumes the completion of capacity at a high level where there is a network densification so that capacity is widely and readily available to the end customer for the various kinds of business models that will be areas where monetization will take place with the end customer. This will be delivered in a highly efficient, agile network. We see the implementation of increased virtualization through SDN, through network function virtualization, as ways to support an application-by-application catering of the network for the quality of service that application requires. You could translate application into those applications that support a cloud workload, for example, or those applications that support vertical transactions, for example, or those applications that support unique M2m vertical applications, for example. The other key tenet in a customer experience enabler model is, of course, knowledge of the customer, awareness of the customer experience, having the ability to understand how to tune the service for customer segments, and ultimately how to monetize some of that capability to understand and cater for the customer experience with the customer and with partners. This, of course, includes the ability to understand the analytics coming out of the network for network KPIs and for service performance indicators, and we'll talk more about that. Key here is that the customer experience enabler network operator is now about catering to multiple business models from a center point of network efficiency and customer experience capability. Just to spend a little more time on these points, understanding what we mean by customer experience management, there are a lot of ways to define that in the marketplace, but we see the aggregation of data across the different silos of the operators being key to an effective customer experience management system that can then be leveraged in the ways we're talking about for the different business models. That can be done through the creation of a customer experience index, as some operators are trying to do, a set of dashboards that essentially enable the services arms of the operator to understand how to interpret customer behavior and leverage that behavior with partners and with the customers directly. As I mentioned, it involves understanding and aggregating the network KPIs to understand network quality and performance, understand the in-service indicators for what the end user is actually experiencing for the end service, whether the service is on network for the operator or whether it's outside the network coming from a Netflix or another source. Many cases today we can see that the operations the KPIs would tell them the network node is operating efficiently. However, the service might not be at the quality that the end customer expects because there are configuration issues, perhaps back at the Netflix server or at the end device. On that note, the third most important component in a full customer experience management approach is integration with the call center and incoming survey data, both real-time data and later analyzed data, to really understand what is the customer segment, what is the customer segment experiencing, who are they, and how can they be served better. And in some cases we've seen really being able to leverage this kind of management data so that the call center agent can respond to the end customer and make changes or react to directly issues in customer experience in real time. Having this kind of robust system, and we do see operators investing heavily in this through the auspices of big data and consolidation of their data silos as a start, is a major source of value We see both AT&T and Verizon suggesting not only can they get internal value from this, but they can aggregate data sufficiently cleanly with privacy constraints in mind to actually make selling this data as a business for them with some of the over-the-tops and other media players. A few examples then of other kinds of appeals that tie in the operator to the over-the-top player. There are three ways in which improved quality of experience over the network can be delivered as a business model. They include an on-demand approach where on an ad hoc basis, different applications can be served to the end customer in partnership with the over-the-top player, such as video on demand or capacity on demand, which is today you might think of as another version of Turbo Boost that you may be seeing, or time and location-based services, certainly a lot of retail applications for time and location-based services, and driving advertising even in today's world. Another way to do it is through planned quality of experience, and we're seeing that manifest through a lot of the service plans that are coming out of the marketplace today include multi-device shared plans or connectivity or number of connected device-based plans that allow the owner of that plan to tune the quality of service or the service type, privacy issues, bandwidth choices in family plans or single multi-account holder plans across multiple devices. That's where our $146 ARPU is coming from, actually, the multiple device flavor of that. We see additional security services, additional kinds of payment services, a number of different things can be built into service plans that can be uniquely delivered by the operator and have an integration with a media company, a finance company, or a over-the-top player. And then there's the ability to bundle quality of experience with their own or over-the-top services for tightly coupled offerings that allow them to do tiered pricing for a given over-the-top service. So these kinds of investments and experimentations are going on in the marketplace in order to learn how to monetize that LTE capacity that's now been delivered into the marketplace. The other area we've been speaking about is quality of experience in the network itself. How is that engineered? Well, there's a number of ways to do it. As I mentioned, the per application catering that you can do when you decouple the network service control requirements from the hardware, so you get more of a virtual approach per application. One of the things that's going to make all the difference in that world is a set of orchestrated policies. So policy management becomes very important in this new network model. And here is a bit of an evolution of what we see going on in the policy world. One of the areas that policy has been focused on initially is basic network traffic management, preventing network congestion, working with ensuring that there aren't outages or there are strong response to outages, essentially managing the bandwidth to make sure it's being deployed in the way it needs to be. Most recently, the advent of policy or the capabilities of policy have been advanced to other drivers, including managing a better understanding of the billing environment, so addressing and avoiding bill shock to make sure policies around subscriber billing are adhered to in the network, and then over the course of the network itself, making sure that a more robust SLA can be monetized by the network for enterprises, for example. But we see this all leading to improved quality of experience on demand drivers. So the policies get much more granular, much more per application, per segment specific. So a lot more distribution of policy across an orchestrated virtual network, allowing superior customer self-service and customer access to segmentized applications for consumers and businesses. We believe this is a key engineering piece of the monetization, which it has so many layers to it. Overall, you can think about the investments that an AT&T and Verizon are making in intelligent networking to get to arrive at this kind of capability as a way to track their investments here. Ultimately, then, we see operators moving from this operator-centric or service provider-centric model where one size fits all to a segmentation model. Three major features of that model we call OpCo, OTTCo, and Enterprise Co. In the customer-centric world, the OpCo's job is to make sure that network has the scale, capacity, on-demand features, and network efficiency across wireless, wireline, and the multi-device world to be available to the other parts of the business model so that network can be used as a monetization tool on a per segment basis or per application basis, or catering to the different business models that we've been discussing. The other major concentration might be OTT Co, we call it. It could be Service Co. This is the side of the network operator that's concerned with the content for catering to the OTTs, catering to media companies, creating multimedia experiences, segmenting the marketplace for business models that give that two-sided revenue sharing with the service content provider, the OTT, or garnering a premium from the end customer for delivering that quality of service for the application. Among the more interesting of these three, we think, is the Enterprise Co. And here we think utilizing the advent of cloud plays and other long-standing enterprise services plays that the operators have entertained in the marketplace, more and more enterprise applications being delivered with a superior quality of service by the operator in exchange for the efficiencies of the network, of the cloud, and maybe even of superior quality of service or security capabilities to reach a cross-section of partners in the ecosystem, perhaps in hybrid clouds or hybrid models or broker models. So the three major models here, we see investments and continued development. Now we're going to dig into some specific investments of some of the key players in the marketplace, those being AT&T and Verizon. Let's examine them and see if we're actually understanding a manifestation of these new business models today. The reality is we're seeing a mix of old and new here. So here we have a summation of AT&T drawn from our forecasting, and we have as I said, tracking the 25 operators in the North American marketplace, and have a much more granular understanding of capex and opex and revenue than this, but this gives you a flavor about how the spend is looking. And interestingly, despite the on the order of $20, $22 billion a year that AT&T spends in capex, we're not seeing an enormous uptick in revenue, or we're not seeing an enormous uptick in spend either. It's a fairly flat, consistent model, which is an interesting understanding. It's really important to look at the operation and understand that this is about moving money within the bars rather than moving the bars themselves. And the movement of money within the bars is going to increasingly move from the connectivity and capacity-driven kind of spend to the new business model kind of spend that we've been talking about. And so we'll see the bottom right view of consistent spend by AT&T shift more from connectivity to the new kinds of business models, quality of service, customer experience management, and eventually AT&T and other operators are going to have to do more to address the ongoing OpEx that all this is requiring. There's a lot of do this process on their own, and that becomes an expensive way to do it. We can see in the revenue that we're also seeing fairly consistent revenue here. We do observe a wireline voice decline, a wireless voice decline, and a thickening of the wireless data and wireline data aspects of the revenue drives for the operator. So let's examine what the operators announced for strategies and where they're going. You may have heard about something called Project VIP, where in the annual statement of investment, AT&T has designated a few key areas where it is placing its bets in the coming year or coming next few years. Number one, it is in the densification of the network. Of course, it assumes completing their LTE rollouts. There was just today announced another raft of locations that were turned on for LTE, with an expectation that by the end of the year they'll have the nearly 300 million user coverage in LTE. As a next wave or a co-commitment wave, they have the rollout of thousands of small cells into the marketplace and the continued support and expansion of their Wi-Fi network. This is to the point of providing the availability of capacity. We see two values here. We see capacity available as a factor of competition. The capacity will enable greater speeds, easier data access against a like competitor in the same market, but it also enables the eventual tuning of capacity for more of an on-demand segmented business model that we've been talking about. So the completion of their density investments is vital to their ongoing plans here. That is also important for AT&T in terms of demonstrating that it has the highest speed network, which is something that's happened very recently. AT&T is able to demonstrate in some markets in the United States as being faster than Verizon and the fastest overall. And after coming from behind in LTE, to be able to make that claim is quite significant for them. And of course, that differentiation is very important when we're engaged in the subscriber battles that AT&T and Verizon and others are engaged in. We can also see them leveraging competitive opportunity to have a shorter term on device turnover, so the monthly turnover on devices, competing with T-Mobile in that space. We foresee that Verizon and others are going to eventually have to follow suit there. This is all just to turn over that subscriber, perhaps capture that new subscriber from the competitor with the device play, with the unique plan play, and with a faster network play. And the combination of HSPA and LTE is giving AT&T a broad coverage at high speed across the country that is only strongly competed with by Verizon. And the density challenge is also being fought by AT&T and Verizon in the denser city populations and buildings and so on. We think AT&T will eventually move to an LTE advanced to keep up with the speed wars, but they probably are in a slightly better position than Verizon now that they've got the speed edge and can continue the densification. The other place they've made a major investment, stepping off of the wireless for a second, is in UVerse and video over UVerse, so sort of a re-engagement with the wireline network as part of their proposition. Not on the same scale of revenue or of investment as in the wireless, but certainly something that they see as a revenue driver that sweetens their offer for triple play and other offers in the marketplace. They have attacked the business, the enterprise side of the market with a combination of fixed and mobile. So it's fiber to the building to make business services access easier through AT&T or at a higher speed. And it's about putting together a mobile offer that combines the features of cloud for mobile services for enterprises and businesses, and helping businesses manage mobility within the workplace with a number of managed offers for mobile business. So we see that ability to leverage the wireless network in the enterprise or the business environment that is part of AT&T's business as well. So where do we see these new business models? A little bit perhaps in the mobile cloud areas. And of course, AT&T has a significant cloud investment where it is expanding its services as a pure private cloud provider and public cloud provider, though a relatively small one on the public side from a revenue standpoint. And we see that as a major investment in this new business model enabled by many of the technologies we've been talking about. We also see them trying out new business models in the M2M space, such as this Digital Life portfolio, which they are high on this year, including advancing home security and automation capabilities across the network for consumers as a different play, a different monetization, still relying on the network but using some application capabilities to deliver a service there. They have also entered into agreements with financial services firms to deliver payment services through ISIS in a mobile wallet flavor, and looking for traction in that marketplace. Both of those, they are seeking this customer-centric, how do we play as a center of these ecosystems, though we don't control the endpoints of the ecosystem. We might not even control all the aspects of the application. Who do we partner with? How do we monetize it? Where does the network play? So those new service concepts, along with cloud, are the vital areas of new technology. And of course, the M2m Connected Car, almost every M2m example starts with a discussion of a connected car, and AT&T, like the other players in the marketplace, have come with connected car concepts, though not as necessarily built out as the enablers I think they can be. We see, for example, that Sprint has developed a connected car concept where it's much more the customer-centric enabler, bringing together partners to deliver the connected car capabilities to Chrysler than some of the ways in which the other players participate simply as mainly the connectivity player. So let's move on to Verizon and understand where they are in the marketplace. Oh, I should mention, I did highlight before that AT&T's acquisition of Leap, and where does Leap fit into that landscape? We believe they're going to keep Leap as a bit of a hands-off prepaid play from a business model standpoint, but have certainly leveraged the spectrum to roll out more LTE capacity, because that does enable them to continue and extend their business model. A major incentive for doing that is what's going on with Verizon. Verizon already completed what could be considered LTE network number 1. Its primary coverage of LTE across its installed mobile network. And then it went ahead and aggressively acquired spectrum from Spectrum Co., from the cables, from T-Mobile in the AWS band, creating the ability to implement what we're calling LTE2. It's not LTE advanced. It's the same LTE technology in a different spectrum that essentially allows them to extend their LTE capacity and effectively double or triple their capacity, in theory, across the new territories that they now have through the new spectrum. So think about Verizon with now doubling its 4G capacity, already having done a successful 3G. This is one of the drivers behind AT&T's casting about for more spectrum and more operators to acquire. This, of course, feeds the connectivity model, the data race, the 100-plus petabits a month that's coming down the data pipe, but does nothing for monetizing it beyond connectivity revenue. So Verizon has to do more than that. It is doing more than that. Before we get to that, though, they're also attacking the small cell business with thousands of small cells being implemented in the network to densify, first fill in and then spread capacities, particularly in buildings and in dense city population areas. Really mirroring AT&T's densification, same reasons, capacity, availability against competitor, and then being able to bring in quality of service by capacity on demand capabilities. Verizon has also taken an investment in fixed again, reinvigorated its spend on Fios to upgrade speeds and push video. Very similar set of drivers to AT&T, very much a parity war there, and certainly to compete with properties such as Comcast, which has extended its dominance in the marketplace on the media side. And then we highlight here more talk from Verizon about the intelligent network. This is where we really see that change starting from inside the network out, so investing in SDN and in a network function virtualization to create an intelligent network that can cater to the applications that we've been talking about. Verizon is moving ahead on that, really making an anchor of its vision. They're also implementing it in their cloud model, the Terramark positioning that they have, competing heavily against Amazon in the public cloud along with AT&T, and beginning to really advocate the position of the operator as a cloud broker for the enterprise in putting forward being the managers of hybrid clouds. Mainly think of a Terramark cloud engagement or installation with some workloads there, some workloads in the enterprise data center, and some workloads maybe even the public cloud, or aspects of workloads and applications. Disaggregated that way, it is quite complicated. Orchestration challenge, where does the workload best be serviced and at what efficiency? Who's going to run that show? And Verizon's putting out a marker saying it's going to be the one to run that. And it's going to be doing it by evolving to more of a software-defined network infrastructure that it will be building along with partners. And then last but not least, the other area of business model development, of course, Verizon has a number of vertical applications and vertical services in its enterprise business. It acquired Hughes for the telematics business and has moved into the connected car through that vehicle, excuse the pun. Also working very hard in healthcare and the public sector in the verticals to extend those business models. And we see that as evidence of the evolution to the customer-centric business model catering to different vertical segments. Long way to go in terms of evolution. So that's the story of the customer-centric business model move we see. So just to summarize, we've taken it from a world of today capacity build-out and densification on the back of LTE, along with small cells and along with eventually LTE advanced on the major networks to increase speed. But we don't see that monetizing the network completely in the way the operators need to. We feel that will lead to an end game of a data pipe, so they will need to move to these customer-centric business models, which require a collection of unique value propositions for different verticals, different applications over the top and M2M, which requires a re-architecting of the network for quality of service and a deep dive into analytics for customer experience management. And we see evidence of all that happening, as we just stated, in the AT&T and Verizon cases. And there are many other cases in the North American marketplace where this kind of advance is moving on. And so we believe this is the way the marketplace will be going. I want to thank you very much for your time, and now we'll take some questions.
Great. Thanks, Michael, and thanks to those of you who sent through questions. As he mentioned, now is the time to send through anything that you want to know what he just talked about. So, Michael, the first question we had that came through is, what do you see as the key technologies that North American operators will be investing in?
So, as I mentioned, probably the top three are LTE advanced after we've completed the LTE investment phases. The software-defined network infrastructure, where there's a combination of their own development and the necessary open source and vendor-provided elements, and network function virtualization, and that's really the application layer on top of SDN that's going to be able to allow the operator to cater their business models for the customer-centric focus that I'm talking about.
Okay. The next one that came through is, what impact will Softbank have on the market?
So Softbank's a very interesting player. They have the reputation of being someone that will come into the market, take the risk to invest at a high level, and then really try and monetize that investment by doing a disruptor strategy. We look at this marketplace and we think there are two disruptor plays. And it's a matter of placing bets on which one Softbank through Sprint will do. One disruptor play is to go aggressively after the prepaid market, to really be the prepaid player and outcompete from a pricing standpoint and a quality of service standpoint the other prepaid players. Think T-Mobile, Metro PCS as the key kind of potential prepaid competitors, although there is some prepaid business with Verizon, AT&T. The second choice that they can make is to be disruptive in the quality of service, new market, customer experience side of the market, and we do see them having a good capability in Sprint as an operator primed to do that. Sprint has done some pioneering work in M2m, as I mentioned, and so they are positioned to take a strong position in that space. They're able to do that with the right investments. The opinion we have is they're more likely to choose a more traditional model, we think, that's going to be more about carving out a section of prepaid, because they can monetize that more rapidly, and they can take advantage of some of the smaller operators in the marketplace, while not ignoring the other customer-centric moves that they need to make. I don't think that's going to be their first play. Their first play is going to be more of a capture the subscription base necessary to prove that they are a strong challenger to be in the Tier 1 space.
Okay. It actually looks like we had a follow-up to the first question, so let me just repeat the first question and then I'll follow up with the second part. Again, the question was, what do you see as the key technologies that North American operators will be investing in? The follow-up question we had came through with, when do you expect those investments to take place?
So the technologies we're really talking about, we see trialing already in 2013 of SDN and NFV. Probably we'll see some low volume of production or commercial applications in 2014, and we don't expect to see robust rollout of these technologies until 2015. Similarly, LTE Advanced it's actually interesting, LTE Advanced is going to be probably happening more sooner in 2014 than would have been expected, because of the speed advantage that Verizon has attained. It's going to incent, that AT&T has attained. It's going to incent Verizon, who has been ahead in terms of its LTE, to put advanced into the marketplace sooner than we may have expected. So maybe 2014, 2015 for LTE Advanced in some markets, and then a more robust rollout where it's going to be viable to raise the capacity that the marketplace demands.
Okay, it looks like we had one more question come through, so if anyone has any additional questions, now's the time to send them through. The last question we have right now, Michael, is what impact will T-Mobile buying Metro PCS have on the market?
So very similar to the situation with Softbank, T-Mobile's acquisition of Metro PCS is giving T-Mobile a breath of life to be able to leverage some capacity and some spectrum available in the Metro PCS network, convert Metro PCS network to greater levels of coverage of LTE beyond what Metro PCS was already doing, and create more of a viable competitor, though still we think it will be a Tier 2 competitor, and we think there's going to be cross-pollination there. Perhaps T-Mobile will learn a few things from Metro's low-cost approach, where quality of service from T-Mobile will have an influence on Metro. We think there'll be a viable player because of that merger, the fourth market player, but think that the competition is going to be more for prepaid subscribers than for postpaid subscribers, not really as threatening to overall to AT&T and Verizon, although we already see AT&T being quite sensitive to T-Mobile policy changes and sensitive to keeping the subscriber ads going or subscriber retention going in light of the kind of campaigns that T-Mobile puts into the marketplace. So all in all, a reinvigoration for T-Mobile that will have an impact on at least making it a four-player market for the immediate future.
Great. It looks like we don't have any more questions, but that's probably a good thing since we actually have run over time. So I want to thank everyone for staying with us for the Q&A portion of the presentation. As I promised, I want to point out the social media links where you can follow both Michael and TBR on Twitter, as well as check out our SlideShare and YouTube pages to get this presentation or other presentations. And there's a couple of things that we've done or will be doing in the next couple of days that may be of interest. First was the Source IT Telecom Report. We did a webinar outlining buyer perception and spend in the telecom industry, so that's available now if anyone's interested. And to let you know about the Network Infrastructure Services webinar that's happening next week on August 15th. So if you'd like to attend that, you can go to the webinar, or the link that you used to attend today's session and register for that webinar. With that, it's time to sign off. So as you're leaving, there's a short survey. There's three quick questions. How good was the presenter? How good was the content? And if there's any other open comments you can give us, whether it's we should be focusing on areas of interest for you or comments about how we're presenting, all that feedback is being taken into account to improve our presentations quarter to quarter. So we really do value any feedback that you guys provide. I'm going to leave the chat function open for another couple of minutes in case there's any last-minute questions or anyone would like to set up a conversation with Michael. And if we don't hear from you now, we look forward to speaking to you guys all again next quarter as we do this same presentation in 3 months for the next benchmark report. So thanks again for your time, everyone, and we look forward to talking with you soon. Have a great afternoon.